Welcome to Westbrooke's COVID Conversations series. Today we're in the UK chatting to Daniel Austin, who's the co-founder of UK-based ASK Partners around the UK secured real estate lending sector. Maybe just to give you a little bit of background, Daniel is one of the co-founders of ASK, which is a specialist independent property funder, and has been originating and structuring real estate debt and equity transactions for the last 20 years. Daniel was previously responsible for the transaction origination division of the structured property finance team at Investec, where he worked for over 12 years, and then set up Capital A Finance PLC, which was a boutique real estate lending business that wrote over £250 million of loans between 2012 and 14. Dan, thanks so much for joining us today.
Pleasure.
Maybe just to start off, for those of us who aren't familiar with ASK Partners, can you speak us through a little bit around the business and what it is that you do?
Sure. Well, I mean, as you correctly mentioned, I was at Investec till 2012, and then we realised after 2008 and the collapse of Lehman's that the bank's ability to lend money against real estate was going to be dislocated for the foreseeable future. There was a lot more regulation coming down the pipe, and it very much opened up a gap for alternative lenders that weren't deposit takers to come into the space, and we've seen that on a massive scale now, where quite a significant proportion of real estate finance in the UK and Europe is provided by non-bank lenders. So as you said, 2012 to 2014, we worked with one extremely large UK family office with a net worth of in excess of 5 billion sterling. But with that came complexities, as there always are when you're working with one source of capital. So in 2015, we decided to set up a multi-funded platform, which uses some significantly large family offices and also over 125 high net worth, super high net worths and smaller institutions. And what we do is we go out and we underwrite interesting pieces of credit, and then we distribute that on our platform via a very diverse range of investors. And that way it ensures that the differing risk and adjusted returns that we create appeal to someone different all the time, to prevent us being in a position whereby one funder doesn't want to do a deal, doesn't stop us executing.
Dan, maybe, we're at the end of May. Maybe just give us a little bit of an update and set the scene for us in terms of where you are in the UK around COVID, lockdowns, coming back from lockdown, and how your business has been impacted up until now.
Okay, so obviously UK is being considered to be slightly late into lockdown, and there's been some criticism of the government, but I think we're at a point now where we're slowly but surely easing lockdown. Things are starting to open up gradually. We're seeing some non-essential retail outlets starting to open next week. The new infections have come right down to case deaths have come down from about 1,000 a day to roughly 250 a day, and that's dropping all the time. I think the combination of the very unseasonably warm weather that we've had, people being outside, there's some optimism that we might get on top of the virus in the next 3 to 4 weeks. So holistically, things are looking a lot better. From an ASK perspective, lockdown's actually been surprisingly good for us, because obviously it's thrown a lot of challenges our existing loan book, which we can talk about later should you wish. But my view is that when things are very stable in capital markets, you get too much cheap credit flooding the marketplace, and that very much happened last year. And last year, although we kept growth relatively moderate, I really struggled to deploy capital the way I like to, in the basis that there was just too much credit out there. And a lot of my competitors that, as I said, were born out of the GFC in 2008, were happy to write real estate loans at higher leverage and at lower margins than we were prepared to do. So it was a tough 12 months for us. Since lockdown, we've managed to execute nearly 70 million sterling of transactions. And that all of them have been principally across three significant deals. And those three have been where funding was in place from a competitor. The competitors let them down because fundamentally they've stopped lending or they've retreated from the sector completely. And we've had the chance to dictate terms and shape a loan that seems to make sense. So perversely, when you're small and nimble like us, really bad macro conditions can create opportunities. And we've seen that. But it would be remiss of me and slightly naive to sit here and say that, you know, everything's rosy on a macro level, because we, like everyone else, will be facing challenges in the next 24 to 36 months.
Dan, I'd like to delve a little bit more into this concept of secured lending. You
Sure.
spoke earlier about a business born out of the dislocation in pricing, some levels and segments of the market where the bulge bracket banks aren't necessarily that keen to lend. Can you explore those fundamentals in the UK market just a little bit more for us?
Yeah, so, you know, as you rightly point out, I was writing loans at Investec from about 2000 to 2012. And during that decade and up until the GFC in 2008, your bulge bracket clearing banks were going up to 80-85% loan to cost, loan to value in projects, and charging 200 basis points over Bank of England base rate or LIBOR, which for you in South Africa, when you have interest rates in the high single digits, seems hard to comprehend. But even at a bank like Investec, which had a sensibly sized balance sheet in South African terms, was a big business, we were having to write subordinate facilities behind other lenders to get capital out the door, or do stuff that was too small for your high street banks. And then in 2008, Lehman's came, and by 2009-10, all bank credit had dried up. And actually, if you wanted to borrow money against real estate, it was virtually impossible. And from there, all these boutique businesses like ourselves set up, and there was an amazing window between 2012 and 2014 where you could lend someone 60-65% loan to purchase price on an asset and charge them 10 to 12%, which a mere 24 months later, you would have only been able to price at 200 basis points. So the cost of credit increased fivefold. And as all the hedge funds and insurers saw that being a non-regulated lender was an amazing way to get kind of quasi-equity returns for taking debt risk, everyone piled into the marketplace, and the ability to write the kind of loans that we had done started to reduce. And between 2015 and 16, we took our foot off the pedal because it just became too hot. And actually, you know, the last couple of years, we were looking for alternative transactions that a lot of people who came into the sector that I refer to as spreadsheet jockeys struggled to understand. So what you saw was a lot of hedge funds coming into the marketplace in 2015, 16, 17, and 18. And their underwriting was very much around what the numbers look like on an Excel spreadsheet and a cash flow. Whereas because we have, in our team of 9 to 10, we have a good mix of property, legal, accounting, banking. We like to think we can appraise a transaction from both the financial point and the real estate point. So we look for deals where we understood the real estate a bit better and hence could take a bit more risk than our competitors in terms of leverage, but without actually taking more risk than we had to. Now we're moving into a very interesting space where the opportunities are going to be easier to find, I believe, but we don't know where the outcome of this recession is. So attachment point is going to be crucial. And I don't know if you saw, but I was watching Stiglitz, who's a Nobel Prize winning economist, and his view of this recession is that, you know, 2020 is impossible to call because unlike, you know, 89, 2000, you know, GFC of 2008, they're all financial crises. They were liquidity crises emanating from markets and banks. We've now got a crisis emanating from something completely different. And the difference is the banks are all liquid. They've got money to lend. And in some respects, that's a lot less scary than it was in 2008. But we've got no demand. I mean, the demand side of the economy was just shut down for 2 quarters, and none of us had ever seen anything like that. Well, not in my lifetime anyway. And there's no frame of reference to say what's coming next. So everyone's as good, everyone's guess is as good as each other's.
So with that uncertainty, where, I suppose, do the opportunities lie? And your take on being a secured lender versus an equity investor in these uncertain times?
I think that if you're underwriting significant size of transactions, so 5 million sterling upwards, it's very uncommon in this day and age that someone acquires a real estate asset without leverage. The leverage returns is what makes real estate such an attractive asset class for most institutions and larger investors. When you have a downturn like you do now, the obvious advantage of being in credit rather than equity is that you call the shots. So fundamentally on our positions, we're in control. If we want to extend our loans, we can. If we want to charge more to extend them, we can. If we want to appoint a receiver, we can. If I was at the other side of that trade, so I bought a load of assets with equity, I'd be the subject of what I've just described. So I'd be having to phone myself and say, please extend my loan. Please don't charge me too much to extend it, and please don't appoint an LPA receiver. So our modus operandi has always been to try and, by using clever structuring and financial engineering, to try and achieve kind of low equity returns for taking debt risks. So when you have an unprecedented crisis like this, if we had to market our loan book, who knows what that's worth, because every value in the UK now has inserted a Covid-19 clause into its valuation. So, they'll tell you what a property's worth, but then they'll caveat, but saying we don't really know because of Covid-19. But what we do know is the choice is ours. It rests with us what to do next. Whereas if you're an equity investor, you can pretty much be told what's happening, whether you like it or not. And your only option is to invest you'd have to follow your money to protect your position without an understanding of whether your equity was in or out of the money in the first place. So how do you know whether it's a good idea to put more capital into a structure? Because you could be putting good money after bad. And a lot of the pension funds, they've had to gate because investors want their money out because of nervousness. There's calls. So they have to shut their funds, and they're fundamentally out of business. As a debt provider, your loan book continues to trade. It does what it does. And even if you're 125% loan to value, there's no one putting a gun to your head. So you can sit, you can wait. If you don't collect interest, well, you can give your borrower an interest holiday if you want to, or you can be very aggressive and take a position because you want to own the asset at the attachment point. You've got lots of different routes to value. As equity, you're at your behest to the debt. So I grew up in lending as well. So that's always been my preferred route to analyze real estate. And with this unprecedented level of uncertainty, the one thing is in the new market, the post-COVID market, if you're lending someone 60% loan to value, which we've done a couple of times, or actually nearer 55%, at 55%, the market can fall 45% before your capital's at risk. If you're an equity investor, the market doesn't have to fall more than 1% or even more than 0.1% for your capital to be at risk. And how do you know if the market's going up or down from May, whatever it is, the 25th of May 2020? We don't know. So I prefer to have that 45% buffer. And in a world where interest rates are zero, about to go to negative in the UK, if we can get leveraged returns in our structures or whole loan returns in our structures of anywhere between 9 and 14%, it would have to be a hell of an equity deal to tempt me into the equity space right now.
I suppose that makes a lot of sense, and we've seen it through the emergence of private lending as an asset class. That arbitrage of getting equity-like returns for debt-like risk profiles makes a lot of sense. You made a point earlier, Dan, that was interesting to me. You mentioned that the high street banks were liquid, and that a lot of people were sitting on cash. So the question is, if private lending is the space to be, there is a lot of liquidity in the market. Where are the opportunities for you going forward if you are to be able to capitalize on this private lending space?
I see that question split into two. So if you're, there's the opportunity in credit dislocation. So I think there will be people who have been using funders like ourselves, and those funders want their money back. And we're seeing that all the time. So we're seeing alternative lenders saying they want to exit the market, they want their loans repaid, when actually there's nothing wrong with the loan. The leverage is right, the covenant hasn't been tripped, but fundamentally they're made back by an American hedge fund or some Asian capital, and they want to repatriate money for whatever reason. So there's a lot of that going on, and then it's up to us as a credit team to try and work out whether we should engage in the game of pass the parcel with another lender or not. And it's up to me to make sure that we're not left holding the baby if things get worse. But we think we've got the expertise to do that. So there will be a lot of refinancing opportunities. There's no doubt about it. And there'll be people who are also looking to buy distress. And actually, they can identify an asset that's distressed, but it's an asset that needs a lot of work. It's a complex asset. It doesn't have a cash flow. And so in order to gear their returns, they need to find someone like ourselves who understand the bricks and mortar behind the asset, not just the cash flow that it is currently and can produce. So that's a kind of a holistic opportunity. If you're asking me where the opportunity is within real estate, I think that obviously there's massive divergence now between sectors. So everyone's got a different view of the office market, the retail market, the warehousing and logistics market, the residential market, the student housing market, what we call in the UK build to rent, which is multifamily in the States. So all of those different segments have got pros and cons going for them at the moment. I see there's going to be a huge glut of retail property. Before COVID, we had somewhere between 25 and 50% of retail property unlet, depending on who you ask. Last year alone, 1,250 retail outlets shut. A lot of those town centre retail is no longer fit for purpose. So I think there's a huge opportunity for developers to work with central and local government to repurpose some of that town centre retail into residential, potentially a small amount of office accommodation, because I think offices may move out of town a bit as well, as people are less excited to travel on the tube, on a busy tube. And I think regional offices and localized offices could be a sector to watch. And you'll get suburban and satellite towns be repurposed from where people go to shop into places that people go to live, play, work, shop, and they do everything. Cutting down, people are going to want to travel less. They're going to want to commute less post COVID-19. So, someone came to me and said, look, Daniel, I want to buy this shopping centre. Obviously, your first question is why on earth would you want to buy a shopping centre? But their answer would be, because I've got 2 years of income to a supermarket, and during that time, I'm going to speak to the planners, and I'm going to keep maybe 2 or 3 a food store, a chemist, and essentials, and I'm going to knock the shopping centre down, and I'm going to build, 100 flats for young people to rent and live, maybe some leisure, and potentially some serviced offices. And then you've got a nice town centre hub where you've got mixed-use activity. And I think we're going to see a lot of that happening.
Dan, it's been really, really interesting chatting to you. That's Daniel Austin. He's the co-founder of UK-based ASK Partners. On today's COVID Conversations, chatting about the UK secured real estate lending sector. Daniel, thank you so much for the time.
Pleasure, Dino.